When that threshold is crossed, sovereign central banks deploy aggressive containment measures to survive. The first tier of response is the infrastructure freeze. During the 2002 crisis, Argentine authorities called an unscheduled 3-week market holiday. The legal infrastructure determining the settlement rate collapsed, leaving offshore funds with correct directional shorts trapped in contractual limbo. The second tier is architectural redesign. In 2016, rather than freezing the market, Malaysia completely replaced its dealer survey fixing mechanism with hard transaction data, structurally eliminating the timeline manipulation that offshore funds relied on. The final tier is the outright ban, executed by India in April 2026. The Reserve Bank imposed a strict $100 million net position cap on banks and fully prohibited authorized dealers from offering NDF contracts to corporate clients. This chart displays the rupee forward premium curve in late 2024. The massive weight of offshore arbitrage flow had inverted the entire curve into negative territory months prior to the crackdown. The warning signs of a distorted market were mathematically visible long before the intervention. The ultimate rule of the shadow market is simple. When the offshore derivative tail wags the onshore domestic dog too violently, the sovereign is forced to break the market architecture to regain control. Despite aggressive sovereign responses, the alpha in this market continuously regenerates due to 3 structural realities. First, capital control asymmetry. A central bank can heavily restrict its domestic onshore market, but it lacks the jurisdiction to policing cash-settled contracts executed in London or New York. Second, information opacity. Prime brokers possess real-time visibility into global order flows, while central banks must rely on delayed surveys to estimate offshore exposure, ensuring the market maintains a permanent informational advantage over the regulator. Finally, policy-induced mispricing. As long as sovereign governments mandate unnatural capital prices by maintaining indefensible currency pegs, they offer the market a one-way bet. Prohibitions like India's $30 billion unwind do not destroy the trade. They merely crystallize the profit. As long as emerging markets enforce capital controls, the offshore shadow architecture will adapt, evolve, and violently reprice them.